things. I want to see the VIX continue to come down. It was in the low 50s. It needs to move down. At these levels, with volatility a concern, they tend to be correlated. And so as we see the VIX coming down in a meaningful way, you'll start to see the equity market pull back also, particularly if we break through into 40 and obviously down to 30. But the other thing is I watch the credit markets. I've been taught always watch the credit markets, and I've seen that investment grade spreads have come in, credit default swaps, losing some of that cost as investment grade spreads blew out. I'm watching high yield. And it was very, very, speaking of restaurants, speaking of food, watching the deal for KFC. They raised $600 million. They expected $500 million. It was oversubscribed. And even the yield at 7 3/4 was better than expected. Never mind, though, in September they raised $800 million at 4 3/4. But this is the first high-yield junk deal since March 4th. I want to see more of this. And I want to see the market going in and being oversubscribed. I think it lends confidence to the notion that at some point we get through this. It also lends confidence, or shall I say not so much confidence, that 10-year Treasury yields are so low and there's a search for yield. But nonetheless, this is the beginning. It's the opening of this market. And I want to see all prices go up because a good portion of high yield comes from the energy patch. And we've been worried about the spillover into other areas of junk. This is a good start. And I love their brands, by the way, just personally.
Right. All right. Let's move to Jim McDonald. What would you like to see to give you the degree of clarity that you need to be able to make some more definitive calls on market direction or individual sectors or both?
Tyler, there are two things that I think we need to pay a lot of attention to. The first is the development of the cases globally. We have seen some improvement in some of the leading European countries. For example, the cases in Italy, new cases have come down for about 10 days now. We're starting to have some confident projections that we're going to see peaks in important states like New York and California in the next couple of weeks. The market's going to be very keen on that. I think the improvement in Italy has helped support the recent rally. The second thing is we're going to want to see that the credit programs that the government is putting in place are actually able to be utilized. Initial comments from companies are they're having a difficult time finding out how to get the SBA loans that are part of the new package. The new package is really well thought of. It gives great support to retaining employees. But if the companies can't get access to those loans on a multiple week basis, that's going to be an issue for the markets.
Yeah, it certainly is. Are there parts of the market that are particularly, Jim, troubling to you right now, or by contrast, ones that you go, hey, listen, I'm seeing some good movement there?
Well, it's an illustration of how tricky the market is. You can look at baskets of stocks that are defensive virus-oriented names, so the stay-at-home kind of stocks, and the ones that are most exposed to the virus, like the transportation companies. There's been a violent shift in relative performance of those as the market has looked at the opportunity for the virus to start to peak. So I think you've got to be a little careful in being too cute around playing that trade. Our favorite sector remains the healthcare sector. It's been more of a longer-term value-oriented play that turns out to benefit from what we're going through currently.